Good day. This is the first part of a six-part series dealing with the cost of capital. In this first session, we're going to deal with the concept of cost of capital, specifically looking at how it is constructed and what the elements are at play. So it gives us a broad overview, and in the subsequent sessions we're going to be focusing more specifically on individual elements, and we'll end this session with referring to those elements. So what is cost of capital? It is the long-term financing of a business. It is what the funding of a business costs the company to operate the business and to invest in projects. And that rate, or that cost of the capital, is the benchmark of which the company should exceed its returns. So if the returns are more than the cost of capital, they're adding value to the business and they're building value in the business. But if the returns are less than the required rate of return of the company or the cost of capital, then we're destroying value, because we are investing expensive money into projects that do not return sufficient rewards. So it is an integral part of the company's long-term investment decisions. It is also part of the shareholders' wealth creation. So if the net present value, in other words the cash flows, the future cash flows, if we discount them back to today's value, if they are more than today's investment, so that in today's terms the cash flows converted to today is more than the cash outflow or the cash investment for today, then we're adding value to the business. The internal rate of return, that is the return of the project and the return of the investment. If that returns a higher value than the weighted average cost of capital or the long-term funding of the business, we'll go into much more detail in the sessions calculating the weighted average cost of capital, then we're adding value. But if the return of the project is less than the cost of the capital, again, then we're destroying value. So it is important, it's imperative that we correctly calculate the cost of capital. But there's a difficulty here. All these numbers are future values. It's not present values. It's not stuff that we already know what it is. So most of them are estimations, and therefore it is difficult to determine what those values are. But we need to do a best possible estimation so that we can take informed decisions for them. One example like this would be the Ford Motor Company that invested in South Africa. Here's a nice picture showing the opening of the new some of the vehicles that they're producing in South Africa, and at the background you see the ship that's exporting, and that is about 11,000 million rand investments from Ford Motor Corporation in South Africa. They expanded their production of the Ford Ranger and Ford Everest vehicles to a total of about 168,000 vehicles a year. That is a big investment, and that's the question that we want to answer in these 6 sessions, is how do we decide whether it justifies that investment or not? If we're returning more than what it costs us, then it is justified. If not, then we should not. So Ford has obviously done this extensively to take a decision like this. So what are the concepts of cost of capital, and specifically focusing on the sources of capital? Where do we find the capital? The first one is debt, and there are a number of avenues in terms of debt. We can borrow from a bank, financial institution, that's normally secured. It's like something like a mortgage bond or whatever, or other long-term funding. Alternatively, we go to the capital markets. So a company goes to the capital market, issue a bond, and that's a debt instrument where they then be funded and they need to make regular payments and also do the final payment at the end. Preference shares, that is a preferred treatment of these shareholders. They've got benefits above the normal equity shareholders. When we look at the equity shareholders, they either provide new equity into the business, so they provide new capital coming into the business, and therefore we're issuing new shares, or alternatively, once the company is operating and making profits, we can retain some of those profits, reinvest that into the business, but ultimately it also belongs to the shareholders, and therefore it's also a form of equity. So preference shares, you'll see, sits between debt and equity. It's because they've got characteristics of both these elements, and we'll go into a little bit more detail in one of the other sessions. I want to refer you to the accounting equation, assets equals equity plus liabilities. And when we talk about funding, it's basically on the right-hand side, the equity and the liabilities. And the composition, the ratio of these two, how they stand towards each other, that is the capital structure of the business. Where does the money come from? Is it mainly borrowed money, or is it mainly shareholder money? And that is then referred to as capital structure. There are a few assumptions underlying the cost of capital. The first one is business risk is assumed unchanged. So as we grow the company and the operations change, we assume that it does not have an effect, a change in the operations of the business. So if we add another project, it does not materially change the operations of the business and therefore does not affect the risk profile of the business. The second assumption that we're making is that the financial risk is unchanged. So there are uncertainties surrounding the level of gearing, and what we're saying is if we're adding more funding to the business because of these projects, that we assume that the financial risk doesn't change in terms of default and the probability of any of these type of negative impacts. So therefore we're assuming that new projects, new financing does not have an impact on the current operation of the business and the current financing structure of the business. And the last one is we deal with after-tax investment. So the cost to the business is after tax. Let's just unpack the risk profiles and some of the return of some of these sources of funding. On the left hand side you can see there are from most secure to least secure. So secured creditors, fixed charge, they're the most secure. It's something like a mortgage bond. There's an asset behind it, and therefore the if there's a default, they can take possession of the house or the property or the office building, and they are secured. Whereas ordinary shareholders has got no guarantee at all. And even if there is some money in the liquidated company, it goes to the secured and some of the unsecured creditors first, and then the preference shareholders and the ordinary shareholders stand way back in line. So looking at the risk, so the risk is very low for secured and very high for ordinary shareholders. The return therefore aligns with that process, because if you've got a very secured investment, you might not require to be rewarded for the additional risk that you're taking, as in the case with shareholders, where they want to be rewarded for the additional risk they're taking. And that also aligns then with the cost of the company, cost to the company. So in the next sessions, we're going to look at the cost of debt in session 2. Session 3, we're going to deal with the cost of preference shares and how to calculate what the cost of preference shares are. Session 4, we're dealing with the cost of equity, and then we're going to bring this together in the weighted average cost of capital to determine what is the cost of capital of a business, and when Ford then takes an investment decision, what is the benchmark return that they are requiring. And then in the last session, we're going to release release some of these assumptions and not be so strong on the assumptions and say, but there are impacts of additional capital bringing into the business, and we want to compare the different projects to each other. So we're going to end this series then with releasing some of these assumptions and applying the principle of taking the best investment decision for a business.